Experiencing losses in trading is inevitable, and they can be both financially and emotionally devastating. How you handle these losses is more important than the losses themselves. Inexperienced traders often let emotions take over, leading to poor decisions like trading through the pain, withdrawing from the market, or trying to trade in revenge. These reactions are counterproductive. Losses might make you question yourself, causing issues like exiting trades too early or too late, skipping trades out of fear, or overtrading to recover losses. Successful traders, however, see losses as opportunities to learn and improve. They treat setbacks as chances to become more skilled, disciplined, and emotionally strong. Remember, the difference between successful and failed traders lies in how they handle their losses. Here are 7 rules successful traders take after a loss to become emotionally stronger and more disciplined. Rule number 1. Limit losses to average win amount. Never let a bad day cost you more than you make on an average winning day. If you usually earn $200 on your good days, don't let a bad day wipe out more than that. Controlling your losses is essential for a long and successful trading career. There are only 4 possible outcomes in trading: a big win, a small loss, or a big loss. As long as we eliminate the big losses, we can live comfortably with the other 3. Risk management is the key factor that determines whether your trading experience will be successful or not. Good risk management can steadily increase your profits, while poor risk management can quickly wipe out your account. Following the 1% risk per trade rule is a good strategy. This means setting a precise stop-loss level so you know in advance the maximum amount you could lose on any given trade. This ties right into the second rule. Always know your stop-loss level before you enter a trade. The stop-loss is a simple yet powerful tool, but many traders and investors overlook it. Using a stop-loss can prevent excessive losses and lock in profits, making it beneficial for nearly all trading styles. Think of a stop-loss like an insurance policy. You hope you never need it, but it's reassuring to have that protection. So, always set your stop-loss and know exactly where it is before you start trading. It's also crucial not to widen your stop-loss when the market moves against you. Stick to your original stop-loss level no matter what happens. Remember, there will always be another trade around the corner. If your trading strategy depends on the success of a single trade, it's not a good strategy. True trading success comes from managing many trades well, both wins and losses. Always use a stop-loss and keep it fixed, as it's key to maintaining a strong and sustainable trading strategy. Rule number 3. Avoid revenge trading at all cost. After a big loss, all sorts of emotions surface: revenge, fear, anger, frustration, self-hate, and market hate. When you experience a big loss, it's impossible to trade with a clear head. Remember, there are over 250 trading days in a year, so there's no rush to jump back in. If you do, you're essentially revenge trading. Instead of analyzing your strategy and making sensible decisions, you're acting impulsively, which is dangerous for 2 main reasons. First, it throws your trading discipline out the window, shifting your focus from the trading process to trying to quickly recover your losses. Trading based on emotions and luck isn't trading. It's gambling. It's a lose-lose situation. If you lose a revenge trade, you deepen your losses with an ill-planned trade. If you win, you might start believing that trading on guts and emotion works, which sets you up for future failures. Rule number 4. Accept responsibility. If you suffer a large loss, own it. Don't brush it aside, hide from it, or blame the smart money for your loss. There's always an excuse for a losing trade, but as traders and investors, we must accept the risks. Until you accept that you're responsible for what happens with your orders, the same thing will keep happening. Accept responsibility and figure out what you could have done differently. This approach reduces the chances of it happening again and is healthier than blaming external factors. Blaming others means admitting you don't control your own trading, and if that's the case, you shouldn't be trading at all. If you control your trading and investing, then you can fix it. There's always something that can be done. It might involve changing markets, adjusting your strategy, or altering your trading style. For example, if scalping the 1-minute chart brings many losses, try swing trading. The solution is there. You just need to find it. Rule number 5. Stop trading for a while. Sometimes it's better to take a break to figure out what went wrong. Use this time to get back to a better mindset where you can refocus. Assess what happened by reviewing events carefully. Think about where you fell short. For instance, did you take too much risk? Was the trade well planned? Were you mentally sharp, or did you hold on to a losing trade hoping to avoid a loss? Taking a break from trading is one of the hardest things to do, but it's a smart move. Wait for the conditions to improve. Preserve your cash, save your sanity, and focus on other things. When the conditions improve, so will your results. Remember, the market will not disappear tomorrow. Nothing terrible will happen. On the contrary, during this time away from the charts, you will likely come up with new, better ideas on how to improve your trading. Rule number 6. Trade lower position sizes. After a big loss, your confidence can take a hit, causing you to skip trades, panic out of them, or become overly aggressive, none of which are good. Take a step back and trade in a demo account for a few days. Because it's not real money, there's less pressure, allowing you to focus on trading without worrying about the financial aspect. A few winning days in the demo account will boost your confidence and put you in a better mental space to trade with real money again. So, after a losing streak, start small. Don't jump right back to the same position size you were trading before. Trade small position sizes in the first days back. A winning day with a small position size will help build confidence, and you can gradually increase your position size as your account balance grows. If you have a losing day, it's easier to handle a loss with small position sizes than with full ones. Even if you win a few days in a row, increase your position size incrementally. I know it's frustrating to start with a small position size after trading larger ones, but it's for the best. Bouncing back from a losing streak is about getting back to basics and implementing your strategy well, not just making money. Money comes from implementing a strategy well. Demo trading and trading small position sizes help you refocus on what's important and start building your confidence again. Last but not least, trading is a journey of continuous learning. Much like life itself, you often learn more from your mistakes in trading than from your victories. When you lose money, use it as fuel to scrutinize your actions, educate yourself further, and tighten your execution discipline. Each loss provides valuable insights into what went wrong and where you can improve, setting the stage for better outcomes next time. It may sound cliché, but shifting your focus from just making money to enjoying the trading process keeps you on the right path. By embracing the process, you stay disciplined and increase your chances of ending up profitable. Remember, every trading setback is an opportunity to learn, grow, and stack the odds in your favor for future success. If you learned something new and found value, leave us a like to show your support. Subscribe to our channel and hit the bell icon to stay in touch with new uploads. Until next time.